discuss on. And you all are aware that market has been very volatile since last 1.5 months, and each one of you are thinking that how do we navigate such situation. So today we'll be discussing on this, that how we can beat the volatility and continue the investments in mutual fund. So to help us in understanding the strategies, we have Sandeep Singhi from HDFC Mutual Fund. He's a product specialist taking care of hybrid and solution oriented products. He has an overall experience of 20 years, and he has worked across departments in HDFC AMC, that is sales, distribution, and product. Uh, so over to you, Sandeep. A warm welcome to you, and our audience is waiting eagerly to understand how they can continue their investing by beating the volatility that has been going on. And since it's a long-term product, I'm sure such situations will keep coming in the future. And what are the essential strategies that they can have to continue their SIP investments?
Thank you, Saju, and very good afternoon, all of you, those who have joined us for this webinar. So typically, if you look at, and Saju was rightly saying, the market sentiments are very volatile. So if you have to define market sentiment, it is like a pendulum, which will swing between optimism and pessimism, making equity investing both challenging as well as full of opportunities. If you look at the recent events, whether it is the election result or it's the geopolitical tension between which has been going on for some time in Russia, Ukraine, or Israel, Hamas, or even the fluctuating oil prices, they all things contribute to volatility. And in such a situation, how do we beat volatility with hybrid strategy? So let me just give you a brief background why we are talking about hybrid strategies. And during the presentation, I'll also cover about why it is important, what are the products which are there, and what happens when the market goes up or the market goes down, what happens to the hybrid portfolios. So just to begin with, I am just sharing the screen with you. I hope this is visible to everyone now. Great. So when I talk about hybrid funds, let me give you an analogy. So if you have to make a cricket team, how would you make a cricket team? You would obviously make a cricket team which will involve a batsman, a few batsmen, you will have a all-rounder, you will have bowlers, you will have a wicket-keeper batsman. And what kind of format or match you are playing will decide what number of batsmen, all-rounders, bowlers, wicket-keeper. Wicket-keeper is any which way is one, but what combination will be there of the batsmen, all-rounders, and bowlers, that will decide the format of the cricket match which you are playing. Say, for example, if you are playing a T20 match, then you will like to have more of the all-rounder kind of persons who are participating in that match. But when you are playing a test match, which is more like authenticate, you need a batsman who would score runs, and you would know bowlers who can continuously bowl about 10, 20, 30 overs in that day. So you would need a dedicated batsman and a dedicated bowler, and probably we will have a limited all-rounder. But when you are talking about a one-day match, it's a 50-over match. So you'll have to have probably a combination where probably you'll have about 2-3 all-rounders and then a combination. So you'll never create a team which will be either of bowlers. You will not create a team which is either of batsmen. So you will create a combination. And similarly, when we are talking about these hybrid strategies, it means we are talking about a combination. And the asset classes which are very popular is, one is equity, the other is debt, another is gold, and then gold probably you can combine it commodities as well. So just moving ahead. So what are hybrid strategies? So if you look at hybrid strategies, they invest basically into 2 or more asset classes, which are like debt equity or debt equity on gold instruments. When you are investing into equity, the main objective of investing into equity is growth of capital. When you are investing into debt, the objective main is stability of capital. And when you are investing into gold, you would like to have a hedge against the inflation and the currency depreciation. So based on these three categories of asset classes, we will mix these products to create various asset classes, various schemes, whether it could be a balanced advantage fund or an aggressive hybrid fund or a equity saving kind of a fund or a multi-asset kind of a fund or a conservative hybrid debt kind of a product. So it's the combination, and we'll touch base on how this combination changes and we get the product. Similarly, on the basis of the taxation also, hybrids can be classified as, say, for example, equity-oriented fund, which is like if your equity allocation is more than 65%, those products are classified as an equity-oriented fund. Then there are products which is like other than equity-oriented fund, but excluding the specified mutual fund. So in the budget, the government defined specified mutual fund is allocation more than 65% into debt and money market instruments, or a fund which is investing into such fund. So for example, if we have an asset allocator fund of fund which invests more than 35% into equity mutual funds, it is classified as other than equity oriented fund. And specified mutual fund is, of course, as I have said in the definition, the allocation is more than 65% into debt and money market securities, which is like a conservative hybrid debt kind of a product. On the basis of the asset allocation also, you can define hybrid products into two broad categories. One is a static. So typically you have a fixed range kind of a static allocation. It will say that probably 65 to 80% kind of a equity allocation you will maintain. And then you have a dynamic asset allocation, which depending upon a model or depending upon the fund manager view, they will decide what kind of an equity allocation one should be maintaining. Why we are talking about hybrid funds is like typically when you look at these different asset classes, they perform differently in different economic cycles. Let me show you here a data point. This is our last 22 years data. And if you look at probably calendar year 2008, the market has given a negative 51% return. But the following year, 2009, it has given a positive return of 78%. So in calendar year 98, it was the worst performing asset class and the best performing asset class was gold. But in 2009, this became the best performing asset. So typically what happens is when the market is going up, people normally tend to chase momentum, and the asset which is performing the best, they try to invest money, and probably that period of time may not be the right time or an opportune time to invest into that kind of a product. That's why we talk about a hybrid kind of a product, which will rebalance the portfolio in between. And I'll come to rebalance when I will be talking about the risk return of these kind of products. Similarly, if you look at calendar year 23, again, it was the equity which was the best performing asset class. So it becomes very difficult which asset class will be performing the best. And so in this year also, probably sometime back, it was looking like gold, maybe the best performing asset. But today, as we speak, probably both these products, whether it is equity or gold, they are almost giving an equal kind of a return. So it becomes very difficult and to choose one particular asset class. So in such a scenario, I think hybrids work the best. So when we talk about hybrid strategies, they are also less volatile than a pure equity-oriented kind of product. So when you are investing into such kind of product, you reduce the nervousness of the investors as well. So why I am saying that they reduce the nervousness of the investors, because if there is a drawdown, if there is a sharp fall in the market, say for example, in the year 2008, when we were saying that the market has fallen by almost 51%, or calendar year 2011, when the market has fallen by 24%, there might be a panic which is created in the market, and there's a lot of investors who try to withdraw the money from the market because the markets are uncertain and they are losing their capital. So that fear triggers that decision to sell in the market. But and that may not be the prudent time to sell in the market. Say for example, in COVID also, in one particular month, March 20, the market fell almost about 20-30%, and then subsequently in the following month there was a lot of withdrawal which was happening from the market. But any person who has hold on for some period of time, they were sitting at good decent returns from the market. So that's why I'm saying that when you are investing into a hybrid kind of a product, so your nervousness is reduced because your allocation is limited to the extent the product has an exposure in the equity, and equity defines the risk. We all know that when we are talking about the various asset classes, we also know that higher the risk, higher is the expected return. And if you look at this chart, which is on the left hand side, if you look at the equity, they have given a best return here, which is about say 16%, and the risk is about 29%. So risk we measure as a standard deviation. So it tells you what kind of volatility this kind of a product will have. So in the equity, you have the highest volatility and you generate a highest return also. Whereas if you look at debt, the risk is very low, which is about 3%, and the return is also about 8%. So lower the risk, lower is the return from the product. Gold is somewhat similar, 13% kind of a risk and 12% kind of a return. So what we all know, and it is demonstrated with this chart also, higher is the risk, higher is the expected return. Now let me also demonstrate you when we are investing into such kind of products. So we also have to look at the asset correlation. Now this is a very important term, asset correlation, because it tells you how these assets are correlated. Say for example, if you invest into equity and debt, they have a negative correlation, which means that if the one asset is giving you a positive return, another asset is giving you a negative return. Similarly, if you look at equity and gold, it is again a negative correlation, but debt and gold has a positive relation. So if gold is giving you a positive return, then there are chances that debt will also give you a positive return. And if the correlation between the two is zero, which means that there is no correlation between the products, the return cannot be correlated between the two asset classes. Why I am talking this is when you are creating a portfolio, you always try to create a portfolio with a negative correlated asset class, because when you create a portfolio with negative correlated asset class, it makes a strong case of diversification, and it helps you to reduce the risk as well. So if you look at this chart, so what we have done here are there are various kinds of products which are available in the market. We have taken the benchmark for these products. Say for example, if you look at the first bar chart, the two bar charts, it's the risk and the return which is being mentioned, and you will see that as we are increasing the equity allocation, the risk also increases, the return also increases. So 1585 means that 15% equity and 85% is debt. This is a product which is known as a conservative hybrid debt kind of a product. Then we have a equity saving kind of a product where your equity allocation is about 25%. Then you have a balance advantage kind of product where your equity allocation is 50%. Then you have an aggressive hybrid kind of a product where the equity allocation is 65%. And finally, which is Nifty 50 TRA, it's about 100% equity allocation. Now the beauty, as I have said in the earlier slide also, with the increase in the equity, which is the risk, you are increasing the risk with the increase in the equity, the risk is also increasing, the return is also increasing. But here lies the beauty. If you look at the Nifty 50 risk, it's about 12.5%, and the return it has generated is about 15.2%. Now let's assume that you reduce your equity allocation by 50%. So we are looking at Nifty 50 hybrid composite debt, 50-50 kind of an index where the equity allocation is 50%. You look at the risk. Risk is almost half when you are investing into this kind of a product. But what is happening to the returns? Return is not almost half. It is only about say 20-30% of the drop in the return, but risk is reduced. And how this is happened? Because this is happening because of the rebalancing, and rebalancing is a very important tool in all the hybrid funds. Now let me just elaborate on the rebalancing, how this rebalancing is happening, because when we are investing in the market, normally people will say that I want to buy at the cheap, at the lowest level of the market, and I want to sell at the peak, which is the highest level of the market. But practically doing such a thing is impossible. You may be lucky one or two times, but you may not be lucky every time. So what probably these kind of products do is they have a defined range of an equity allocation. The moment it goes below or above, they have to rebalance also. And there are products also which are model-based products which helps us to decide what kind of an equity allocation we should be running at this point of time. Now, let me give you an example. Say, for example, we are talking about 50-50 kind of a product where your equity allocation is 50%, debt allocation is 50%, and market has performed phenomenally well. Equity has given a fantastic kind of returns over next 2-3 years, over the past 2-3 years, which has happened also. And now your equity allocation changes from 50-50 to about say 60-50. So what you have to do is you have to again come back to the allocation of 50-50, and how we can do this is by selling the equity allocation to the extent of the 10%, so that your equity allocation reduces to 50, and buy debt wherein your debt allocation increases from 50 to 50. So when the markets have moved up, we are able to sell. And just consider a reverse scenario as well. If the market has fallen sharply, say the asset allocation changes from about say 40 to 60 kind of a level. So what the fund manager has to rebalance is he will sell debt and buy equity, so that an equilibrium of 50-50 equity exposure is being maintained. So this is how you are able to reduce the risk to a larger extent, but you are not compromising on the return to the extent of the reduction in the risk. And that's why these hybrid funds are a very good products for an investor who is first time investor or a seasoned investor or maybe a retiree. So these products are suitable for all kinds of investors. The only thing we have to decide is what is the risk appetite of an individual. If you are a conservative kind of a product, probably you can look at an equity saving kind of a category. If you are a middle kind of a conservative investor, you can look at a balance advantage kind of a product. If you want a regular income from these kind of products, you can do a SWP, systematic withdrawal plan, from say the balance advantage kind of products. And if you want to have a little more aggressive allocation towards the equity, you can always look at the aggressive hybrid kind of a product, which is like a 65-35 product, which wherein the equity allocation is about say 65%. So hybrid strategies offer solution to conservative to aggressive investors. We have spoken about it. Hybrid strategies also rebalances the portfolios on an ongoing basis. This also we have discussed, and we also discussed with the example how the rebalancing is happening. So when you look at these hybrid funds, when we are talking about these rebalancing, say probably you can say that I have the best of the equity products and best of the debt products. I can do it, manage it individually as well, but it becomes difficult to execute the transaction on both the legs. So what these hybrid funds do is they are automatically rebalancing the portfolio, and you are saving on the tax as well, because when you are doing it individually, you might have to incur some taxes in form of the long-term capital gain taxes, and accordingly you will be taxed. But when the mutual fund is doing this rebalancing exercise, they don't have to pay any taxes because it is formed as a trust, and trust does not have to pay any taxes. It is only once you redeem, your tax incidents will come into picture. So from the HDFC bouquet of products, we have a host of bouquet of products. I will concentrate only on few products, which is like HDFC Equity Savings, HDFC Balance Advantage Fund, and HDFC Hybrid Equity Fund. Just to demonstrate how these products are being positioned over a risk return graph, and we have also spoken this in the earlier risk return chart as well. So equity saving is a kind of a product which is like for an investor who has a very conservative view over the risk. They do not want to take too much of a risk from the investment. So these are the products which typically invest into equity in the range of about say 15 to 40%. And this being an equity oriented product, you probably would invest about say remaining part, so that becomes 65% into arbitrage, so that minimum 65% is being maintained in the equity oriented stocks, and remaining part is invested in the arbitrage. So if you look at these kind of products, these are fairly stable kind of products, and if you are investing for more than a year, 2 year, this product might not have given you a negative return of if you have invested for more than a 2-year basis. Now, balance advantage fund is very interesting category of fund, as the name is suggesting, balance advantage. It's a dynamic asset allocation kind of product, where what we do is we follow a model, and this model is based on the two parameters, trailing price to earning and earning yield by bond yield. Based on these two parameters, We then look at the macro overlay, which is like the macro factors, the growth factors, the inflation factors, the overall scenario in the world. And based on this, if we feel that the fund manager feels that the the macro outlook is looking bullish, he can increase the equity allocation by about, say, 10%, and he can drop the equity allocation by 10%. So if the outlook is not very positive, and then this allocation is given to the equity fund manager to invest what kind of a equity allocation the product will be maintaining. So today the balance advantage is almost about, say, 51% kind of an equity allocation, and it depends. So when the markets are expensive, it reduces. When the markets are cheap, it increases the equity allocation. That's how this product would work. Aggressive hybrid fund is a product where you will maintain a minimum equity allocation of 65%, and it goes up to maximum 80%. So it will typically have a equity allocation between 65 to about 80%. So on an average, if you look at the balance advantage, so there is a probably a question can come in: what is the difference between the two, balance advantage and aggressive hybrid? It is basically aggressive hybrid is more a static kind of an equity allocation which is being followed, and balance advantage is a more of a dynamic asset allocation which is being followed, and it follows a model. The model suggests what kind of an equity allocation, and both these products are a equity oriented product, which means that after 12 months you have to pay about, say, 12.5% kind of a tax, and the first 1.2 lakh rupees of redemption with what you are doing from these kind of category of funds, it is exempted under the tax as well. So another most important part of this is the equity allocation. Say in case of a aggressive hybrid, this is as on October 31st, you have about, say, 67% equity. In balance advantage, it's about 52%, and equity saving, it's about 32%. So depending upon the equity allocation and depending upon the risk appetite, one can choose these kind of products. One most important part is cash flow part. So typically what happens is when you are investing into hybrid funds, so typically if you look at today, there is a need to have a regular cash flow, and these kind of regular cash flow can be generated through mutual funds, and this is known as systematic withdrawal plan. This is exactly the opposite of systematic investment plan, SIP. So in SIP, what you do is you are investing a fixed amount on a fixed date for a long period of time. Just reverse it. You are withdrawing a fixed amount on a fixed date at a fixed rate for a long period of time. That's systematic withdrawal plan. So in this illustration, what we have done here is a person has invested about a 12 lakh of rupees, and he wants to withdraw almost about 8,000 rupees per month. For simplicity's sake, what we have done here is we have started withdrawing from the next month onwards. It is better that probably you can accumulate the funds for some period of time and then start withdrawing. But for simplicity's sake, what we have done here is we invested 12 lakh rupees, and from the next month onwards, you have started withdrawing 8,000 rupees. So now the tax incidence comes only on the income part, and here the income is only 4,364. Remaining is the principal component. So since this is being done from the next month onward, which is like a short term, so you have a short term rate of about, say, 20%. So you 873 rupees is being paid. Otherwise, what will happen is when you are withdrawing money from any of the products, which is like fixed deposits or pension plans, the entire amount what you are withdrawing, you have to pay at the marginal tax rate. So by withdrawing through a systematic withdrawal plan, you are actually withdrawing at a tax efficient way. I think this is all from my side. Saju, you can open up for Q&A.
Sure, Sandeep. Thank you so much for taking us through this hybrid strategies. So everyone, we are open for question and answer. So you can either click on the chat or Q&A icon and post your questions. So, Sandeep, the first question that we have is, Vijay would like to know what is the expense rate for these funds?
Okay, so the expense ratios typically for the regular plan for balance advantage is about 1.35%. For equity savings, it will be about 1.90, and aggressive hybrid it will be about 1.68% regular plans.
The next question that we have is, what is the difference between mid, small, mid and small cap funds with regards to hybrid?
Okay, so let me first define what are large cap, mid cap, and small cap funds for you is, and then probably we'll touch base on the hybrid. So, SEBI in 2018 did a categorization of these schemes, and it said that top 100 companies based on the market capitalization will be known as large cap. Next 150 will be mid cap, and remaining after beyond 250 are the small cap funds. So, when you are talking about hybrids, these are basically invest into large, mid, and small cap companies also. But since these are hybrids, predominantly a large part of money is being allocated more towards the large cap oriented stocks.
Sure.
I think in the present market scenario, hybrids are very an interesting opportunity for the investors to look at it. One can choose the product based on the individual risk appetite. If you are looking at a traditional fixed deposit kind of products or traditional instrument products, a plus kind of a return, then probably equity savings are the ideal choice. Probably you can look at those kind of products. And if you are investing for a long period of time, then probably aggressive hybrid and balanced advantage funds can be looked at it.
We have one more question, that is SWP withdrawal. What amount is taxable?
So as I have discussed earlier, it's so when you are doing a redemption from mutual funds, so SWP is like you are redeeming part units. So when you are redeeming part units, there are two components to that unit. One is a principal component, another is an income component. On the income component, you only have to pay the tax depending upon whether that income is short term or long term. If it's loss, in that scenario, you can carry forward it for about, say, 8 years. And of course, you have the exemption of 1.25 lakh rupees on an annual basis if it's an equity oriented fund.
So, this is the last question that we take before we wind up, Sandeep. So, uh, doing an SIP in a hybrid fund make more sense, or someone who has just retired and wants to park his money, uh, he can opt out for, rather than going for an FD, he can park his money in a hybrid fund and then do an SWP.
Yeah, I think both the points are good. I think it would be also interesting for your RMs also to just do a small analysis wherein probably what you can do is you can look at the hybrid fund returns over, say, 5-10 years, and you compare it with a equity oriented kind of a product. So the illustration which I have showcased you, wherein your risk is reduced drastically but your returns are not compromised too much, so probably that will also help you. And of course, you have rightly said, a person who is retiring should always try and look for these hybrid kind of products and do a SWP. And SIP is any which ways is a better tool for accumulation of the funds. if a person has a long period of time. So accumulation is one part of it, and distribution, which is SWP, can be the second part of it. And you can do distribution for multiple things. I'll just give you another example. Like, say, for example, if you want to create a regular cash flow for school fees, you can do that. So every quarter you have a fixed, this is the school fees which I have to pay every quarter. You can create that corpus and start withdrawing on a quarterly basis for your school fees. There are cases wherein people want to retire early. You accumulate a corpus and start withdrawing money on a regular basis through SWP. That's for the retirement, that's for the kid. So there could be multiple cases where you see probably a regular cash flow is required. You can always generate those cash flows through SWP. There is another instance wherein an entrepreneur has started his journey, but then there is some necessary expenses which he has to meet out every month. But then he has also created a corpus to fund those expenses. He can also withdraw from those corpus to fund those regular necessary expenses.
Sure, Sandeep. So all these schemes are available in direct scheme, right? Apart from regular, the ones that we discussed.
Yeah, every scheme has a direct plan. So direct plan will be a tad lower expense ratio than the regular plan.
Sure. I think, Sandeep, with this we can wrap up because we don't have any further questions. Thank you so much, to help us with the strategies, all weather strategy wherein an investor who is looking to have a steady investment without taking much of a risk and does not want too much of a volatility in his portfolio, he can definitely opt out for this funds, hybrid funds. So before we wind up, any last thoughts from you, and then we can wind up.
No, thank you, Saju, for inviting me. And these are a unique kind of products. It is a blend of both the equity and debt, wherein a person who wants to have an exposure in both the kind of category of products can invest in. And all those persons who would like to do an investment, please get in touch with your relationship manager at HDFC Securities. They will help you to guide, and they will plan for you based on the risk profile of your, and accordingly they will suggest the products.
Thank you so much, Sandeep. So thank you everyone. With this, we end today's webinar.
Thank you, Saju. Bye.